Okay, let's unpack this. For years, the chat around Bitcoin has mostly been about price, right? Is it going up? Is it crashing? But today, we're really setting aside that day-to-day speculation. We want to go deeper. We're looking at this fundamental battle.
Mm.
Can private, decentralized digital money, like Bitcoin, ever really get the same kind of status as, state-backed currency? That's the core of what we're calling Bitcoin's challenge for moneyness.
It really is the big philosophical and economic question here. We're stepping beyond just the tech specs today. We're going to apply a pretty robust theoretical framework, neo-chartalism, to see if a currency that was, frankly, designed to avoid the state can actually work as money. Money as defined by political, social institutions, that tension, private versus state authority, that's our mission for this deep dive.
And we've got some great sources. We're looking at the original white paper, the kind of chaotic real-world market stuff it kicked off, and also some pretty strict academic takes on whether it's actually viable. It's a fantastic range of perspectives, and we're going to try and guide you through it. So let's start right at the beginning, the origin story. Back in 2009, this pseudonymous creator, Satoshi Nakamoto, sets up Bitcoin with a really clear, almost radical goal, a peer-to-peer electronic cash system. And that P2P part is key, isn't it? Peer-to-peer, meaning absolutely no central authority. No bank, no government, no Fed in the middle, nothing.
Exactly. It was a direct reaction to the financial system centralization, especially around that time. The whole architecture is built on this idea of decentralization. It's the community, the participants who collectively manage everything, issuance, circulation, oversight. And if you really look at it, that removal of central control is the biggest difference mechanically between Bitcoin and, say, the US dollar.
Right. And mechanically speaking, the currency itself is a kind of digital fiat money. It doesn't have intrinsic value. You can't, hold a Bitcoin coin made of gold, which is actually an interesting parallel with modern cash, most of which isn't backed by gold anymore either. It gets created through this process called mining. It involves complex calculations, right? Proof of work.
That's the one. But the economic rules programmed into Bitcoin are completely different from traditional currencies. Unlike state money, Bitcoin's supply has a hard cap. It's mathematically limited to 21 million BTC. And the schedule suggests they'll all be issued by around maybe 2040. This built-in scarcity, it creates this structural deflationary pressure, which is the total opposite of what most central banks want. They usually aim for a bit of inflation.
That scarcity plus no central issuer. It really put Bitcoin in a different league from earlier digital money attempts. Okay, here's where it gets really interesting. Our sources bring up this classification from the European Central Bank back in 2012. It was an early try by, traditional finance to figure out what to do with this new kind of asset.
Yeah, they tried to map out virtual currencies on a kind of spectrum of usefulness or moneyness, as you put it. At the very basic level, you had type 1 closed systems, only usable inside their own little world. Think of old game currencies, maybe WLW gold. Fun, but definitely not real money.
Right. And it's funny thinking the same system analyzing Bitcoin also looked at, currency for buying a virtual sword.
Yeah, well, it shows the evolution. Then they had type 2. These were unidirectional. Things like old Facebook credits or even airline miles. You buy them with real cash, use them for stuff, but you can't ever change them back into dollars or euros. It's a one-way street.
And Bitcoin just blew right past that category. It landed in type 3. Bidirectional. You can buy it with fiat, use it for things, and critically, you can convert it back to fiat currency. That ability to move between the traditional system and the crypto world, that gave it way more flexibility. It pushed it much further along that moneyness spectrum than anything before it. Okay, so on paper, Bitcoin seems to have gained serious economic weight. But does it stand up to, a tough academic critique? Let's bring in that theoretical challenge. Neo-chartalism.
Right, neo-chartalism. It's this academic framework that argues money isn't really about the stuff it's made of, but about its political and institutional roots. You have thinkers like Knapp, Innes, Lerner. They basically all argued in different ways that money is fundamentally a creation of the state.
Okay, can you boil that down for us? What's the absolute core idea we need to grasp?
The core idea is that money is essentially a social and political construct. It represents a kind of debt or claim established by the state, the physical form. That's secondary. It changes all the time, gold, paper, digital entries, whatever. But the state provides the authority. It establishes a money of account, a standard unit for measuring value. And crucially, the state makes it legitimate by demanding it for tax payments. Taxation is what forces acceptance and gives state money its claim on the overall economy's output.
Okay, I get the theory, but hang on. Why should a totally modern digital currency even care about a theory from, what, the early 20th century? Isn't the whole point of Bitcoin that technology makes the state's approval kind of irrelevant?
Well, that's exactly the tension, isn't it? Because according to this neo-chartalist framework, Bitcoin has some fundamental problems in achieving stable moneyness. We can break down their critique into about three main areas.
All right, let's take the first one.
Okay, first, materiality. Now, the theory actually accepts that money doesn't have to be physical. Digital is fine in principle, but Bitcoin fails the test because no public authority, no state, has officially adopted it or designated it as the official currency. Governments might tax it or regulate trading, sure, but none have said, this is our money, you can pay your taxes with this.
But couldn't you argue the opposite? The very fact that it exists digitally and holds massive value without state backing seems to challenge that part of the theory itself.
Not quite from their perspective. The Chartalist view evolved to say it's the state's authority over the unit of account, not the physical stuff, that matters most. Which leads directly to the second point of failure, issuing authority. Bitcoin doesn't have one, not in the state sense. Its value relies entirely on, well, private users agreeing to transact with it over and over again, decentralized agreement. This makes it inherently volatile, susceptible to shocks. If there's a major hack or if governments coordinate a massive regulatory crackdown, there's no central bank or treasury to step in and stabilize it.
Okay, and the third piece, you said it was maybe the most crucial.
Yes, the debt-claim relationship. National currency is deeply institutional. It represents a claim on the nation's total economic output, a claim managed through taxes and government spending. Bitcoin just doesn't have that mechanism. Holding Bitcoin gives you a private claim against other users who might accept it, yes, but it's not a mandatory token you need to settle public debt like taxes. So, from this neo-chartalist viewpoint, it lacks that fundamental society-wide functional claim.
So the verdict, from that theoretical perspective, is pretty clear then. Bitcoin lacks the public authority, the institutional backing needed for real, stable moneyness.
That's the argument. Theory says it falls short.
Okay, but theory often clashes with, messy reality. Let's shift to how Bitcoin actually operates in the world, whatever the academics say. It clearly does something. It has users.
Oh, absolutely. As a medium of exchange, it actually saw pretty interesting early adoption. Our sources mention that even back in 2013, something like 1,300 merchants worldwide were accepting it. And because of that scarcity, we talked about the hard 21 million cap for many people. It acts as a compelling store of value, like digital gold. And sometimes, depending on network traffic, it can be an attractive payment method because the fees can be lower than traditional systems.
But those same unique qualities also bring huge risks. We can't really talk about its function without touching on what our sources call the dark side.
Yeah, the elephant in the room has always been the extreme volatility. We've all seen the price charts do these incredible whiplash moves, like in 2017 going from maybe $1,000 to over $10,000 and then crashing down just as fast. That kind of instability just confirms that for most people and most businesses, it's still way too risky to be reliable money. It's more like a high-risk investment or just pure speculation.
And there's an irony too, right? Decentralization is the big selling point. But to actually buy and sell it easily, you often rely on centralized exchanges. And those have been, well, vulnerable.
Exactly. That's the paradox. You look at huge disasters like in 2014, what was it? 850,000 Bitcoin just vanished. It shows how these centralized points, the exchanges where most people trade, become massive targets and points of failure. So the infrastructure built around this decentralized currency reintroduces the very risks Bitcoin aimed to solve.
And we should probably also mention the less exciting but still disruptive side effects, like the whole graphics card market chaos caused by mining.
Oh, yeah. That was wild. The demand for GPUs for mining rigs just exploded. It led to massive price hikes, shortages for regular consumers and gamers, even people apparently reselling burnt-out cards. It had a real physical and pretty negative impact on a whole other industry.
Plus, you can't ignore the illicit uses.
No, you can't. The anonymity or pseudonymity, while a feature for some, inevitably attracts use on the dark web. Illegal gambling, drugs, money laundering, that forces regulators to focus more on cracking down on crime than maybe, fostering the technology's potential benefits.
Okay, so it's complicated. But maybe the most telling sign of Bitcoin's impact is how governments are reacting globally. All these different regulatory responses from countries everywhere. That reaction itself kind of proves Bitcoin matters now, doesn't it?
It definitely shows it's being taken seriously, even if the approaches differ wildly. The response is, well, it's all over the map. On one side, you have acceptance and integration. Countries like Japan were early movers, officially recognizing it as a payment method back in 2017. Germany classified it as a financial instrument. The U.S. taxes it like property, like an asset, and importantly, allowed Bitcoin futures trading on the CME. That really brought it into the fold of traditional finance.
But then you have the complete opposite restriction and outright bans. China cracking down hard on exchanges, trying to stop capital flight, Russia initially calling digital currencies illegal.
And that lack of a unified global stance really highlights the core problem for regulators. International bodies like the G20, they're moving pretty slowly. Why?
Okay.
Because Bitcoin doesn't fit neatly into existing boxes. Who is the issuer? There isn't one in the traditional sense. You can't apply standard currency rules or debt rules easily. It forces them to invent whole new legal frameworks just for crypto.
Okay, let's switch gears slightly to something that is predictable about Bitcoin.
Yeah.
Its internal economic clock, the scarcity engine, the halving. Understanding this seems crucial for understanding its market behavior.
It absolutely is. It's probably the most predictable yet fundamentally impactful event baked into the Bitcoin protocol. The halving is just this pre-programmed event where the reward miners get for validating transactions and adding a new block to the chain gets cut in half. It happens roughly every 4 years, technically, every 210,000 blocks. This is what guarantees that 21 million supply limit is eventually reached, and it systematically reduces the rate of new Bitcoin creation, lowering its inflation rate over time until the reward eventually becomes negligible around 2040.
Historically, looking back, this halving mechanism seems to set the rhythm for major market cycles. There's a clear pattern, right? A real nugget of data here. The price tends to see a big surge, typically in the, 12 to 18 months after the halving event?
That's the observed correlation, yes. The 2016 halving is a pretty clean example. The reward dropped in mid-2016 when the price was around, say, $650. About a year later, it had surged past $2,500 and then kept going into that massive 2017 peak. So the pattern suggests that this program supply shock gets priced in, but maybe with a significant lag.
So looking forward now, the recent 2024 halving and the cycles people are thinking about for, say, 2025, 2026. Are they being seen differently this time?
Well, yes and no. Analysts definitely expect that typical post-halving upward trend to play out into 2025, maybe 2026. But what's different this time is the context. It's being reinforced by something huge, significant institutional adoption. Specifically, the approval of Bitcoin ETFs in the US. That just makes it so much easier for traditional investors, pension funds to get exposure. So the long-term predictions, looking out even towards 2030, suggest this institutional buy-in could help stabilize things a bit, maybe solidify Bitcoin's role as digital gold, potentially dampening some of that wild volatility we saw after previous halvings, could be shifting from pure spec asset to something more foundational.
So what does this all mean? We started this deep dive talking about Bitcoin, this thing engineered really specifically to be outside of state control, founded on the idea of kicking central authorities out of finance.
And where we land is this deep irony. Bitcoin's actual value, its legitimacy, its risks, basically, its entire future, seems increasingly tied to the actions of the very states it tried to ignore. Regulation, taxation, international agreements. Whether governments try to support it or restrict it, their actions are shaping its destiny. You could almost say the state's struggle to control or define Bitcoin inadvertently proves how important, how powerful it's become.
Yeah, the core conflict is still there, that neo-chartalist idea.
Hmm.
Real money needs the state's stamp, confirmed by taking it for taxes. But here's a final thought for you to chew on. If the global trend keeps going like this, with states all over the world building these incredibly complex, bespoke regulatory and tax systems just for Bitcoin, does the sheer effort involved, the necessity for the state to engage so deeply, actually prove that Bitcoin has already achieved a kind of social and economic power? A new kind of gravity, maybe, regardless of whether it perfectly fits that old definition of moneyness?
That is a really compelling question, and I think we're going to see the answer play out over the next 5-10 years. It's definitely one to watch.
Yeah, absolutely. Well, thank you for diving deep with us today on this.
My pleasure. Until next time.